Fear in the markets is rising. We are seeing this across the board on market sentiment. However, the charts are telling a very different story once again. Today's video, let's look at how this fear porn is rising in the markets, yet we're not seeing the same thing flow through from investors, and basically what we can expect over the coming months in 2023. This thing has happened twice for BTC, and it's extremely important for the market to go through this type of fear porn to reset where the market currently sits. And the most important thing we look at is, of course, the timing of the market. So let's take a look at that in today's video. This is your home of macro cycle analysis across crypto, Bitcoin, stocks, and the real estate market. Don't go anywhere. Links in the top of the video description. You can join our TIA members. This is where they are doing phenomenal profits on their crypto trading. And it's the same analysis that can be used across any market. So if you're looking to trade stocks as well, what we teach in TIA Crypto, the TIA Premium membership, will help you invest longer term in stocks, crypto, whatever it may be. This is just over the last 24 hours, so congratulations to you guys who are smashing these wins. 50%, 164%, 106%, and these were the ones from yesterday. So don't delay it any further. Link in the top of the video description. This is where you will learn how to beat 90% of the market. Like and subscribe, guys. Let's get into today's video. As I talked about yesterday, in that video where we're looking at altcoins dumping while Bitcoin remains relatively stable, we have seen a similar sort of thing play out across the markets where we're getting more and more of this fear porn. I don't know if I'm going to get delisted from YouTube for using that word, but that's essentially what it is. Fear sells better than the bull market, and we've been trying to help as many people as possible throughout this bull market. That is a clear bull market now, because there is mostly fear porn out there. Every time we get some of these bottoms, these severe drops, we get some sort of reason that the media comes up with to tell us this is why it already happened. In the market, we need to forecast what we think is going to happen in the future. Now, you can do that on a short-term time basis. We use a lot of technicals for that. But if we're looking at a little bit longer-term time here, looking at weeks, months, maybe even years, we're using macro cycles here. We're understanding what's going on with the fundamentals, but more importantly, the cycle. Are we in a uptrend cycle or are we in a downtrend cycle? And we're clearly in an uptrend cycle with periods of digestion. So we're down now for the S&P about 4.5%. If we just take a look back at each of these pullbacks, they weren't anything more than basically single digits. So we've gone through this. That is our thesis moving forward into this correction that we're going through for August, potentially September, and this sort of Q3, early Q4 period of 2023. Single digits, even 8.8% in the banking crisis, the crisis that was supposed to collapse the market. But instead, from that crisis low, we saw prices rise 20%. And basically, most have missed out on the gains from the cycle low to that top of 32% on the S&P. This is what happens time and time again. This is why over 90% of people miss out on the gains, because they're sitting on the sideline waiting for a collapse because fear sells better, and it's ingrained into us. So it's not necessarily our fault. It's just the way we see the market, the way we see life, is that we're always looking for something to hurt us, when in fact, the markets typically go up. I mean, that's just looking at a chart over hundreds and hundreds of years. These things typically go up. So it's the probabilities are not in favor of the bears longer term. So we need to recognize that and put into action a strategy that is going to keep us on the right side of the market and remove the fear. So each of these dips, we've had some sort of fear going through the market, but where we currently sit is 4.5% down. Very normal at this stage in the market, especially after a 20% move from the banking crisis. We had the debt ceiling crisis, which no one talks about anymore, but that was the biggest thing back in May and June. You know, if the US couldn't pay back their debts, this is going to collapse the market. It was actually the smallest correction out of anything from the cycle low. That was probably the weakest fear porn they could have come up with. So right now we've got some other fear porn about the correction now. The downgrades, something about the US. There's always something in the headlines that is there to fool us. 4.5%, if we look down to our level of potentially where we expect the market to at least have some sort of support, about 6% down takes us to about 43.50. So this is all happening for Bitcoin as well. Bitcoin's also having a pullback, and we're going to look at those significant levels and where Bitcoin could find some support. So in terms of the bull market, nothing has changed here. This is a normal correction that we're going through. We had to have one eventually. We looked at timing here. We had 16 weeks up. We've had 19 weeks up. It happens. And so you see the same sort of thing play out time and time again. The VIX is also showing the same thing. As we get some lows coming into the stock market, you're going to see the VIX spike, but it typically remains between 11 and 17 on this reading throughout the bull market. So this is the bull market zone. You can see it very, very evidently. And eventually we finally get that turn towards the end of the cycle, get a spike out, and we come back in. Within the bull market, there are going to be times where we typically come out to the mid-20s, maybe even to the mid-30s, but then find our way back into the bull market zone yet again. These are the perfect times to be buying the dip because we are in a macro cycle uptrend now. When we're in a macro cycle downtrend, we do not want to be buying those dips, but the tides have changed. We're in that macro cycle uptrend. That's the VIX. It's telling us the same thing. We've covered this multiple times on the channel as well. So this is basically just an update to let us know how to read the VIX. Many have read this in the opposite direction, thinking that when it comes under 17, that's a time to be fearful and the market's going to collapse. It didn't happen. So make sure you are on the right side of the market and understanding how to read these particular charts, the data that comes through. Speaking of data, we've got the fear and greed as well. This is the reset. So we've got the fear and greed model for the S&P, and we've got the fear and greed for crypto as well. We need these to reset. We've been way too greedy in the markets. You can see these tops here above 80. We want them to reset under 30. That's what this green line is here. You can see the excessive pessimism at 30. This is coming back down and we are nearly there. And history has shown that these levels are particularly good times to be buying the dip. Don't switch off from here. Don't get too sucked into the fear porn out there. This is going to be one of those opportunities. And I suspect the low, wherever that comes in, whether it's now at 4,400, whether it's here at 43, whether it's back here in the 42s for the S&P. We'll get to Bitcoin and crypto. Don't worry about that. When that comes in, these are going to be those times to be buying. I do not think the market is going to break down underneath these zones. This was the accumulation and reaccumulation zones before that breakout. Typically, it's not 100%, but typically the markets don't come back and on a closing basis, coming back under and the market starts to close under here when we have broken out of these zones and we're in that new bull market stretch. The majority definitely want it to come back in here, and they'll tell you things like, oh, one last time back underneath these zones is what the market needs. It's BS. It's not based on anything. They're not looking at charts. They're not looking at breakout zones. They're not reading the tape, meaning the price, to identify what the insiders are doing. I don't think many are going to let it get back under here, if at all. If it does get there, it'll be a very brief period, but if at all, because of that type of structure that we're looking at right now. So the fear and greed is sitting at 37 on the reading here. This is from Sentiment Trader, okay? So keep that in mind. This is based off of, for those who are wondering, the CNN public website, which is this one right here, which is actually at neutral. So this one I find a little bit more accurate. Now it's on a subscription, so it's up to you whether you want that or not. But of course, I'm covering this on the channel. Thanks very much to Sentiment Trader and the subscription here, which I thought I'd give a mention to because it's been very, very helpful to be on the right side of the market. And they put in a few more data points that help identify this. So look at the bull market here that you had from 2019 into that peak of 2020. Goes under 30. Very good times in the market to be buying up these dips, even though the market was relatively, looking back now, relatively flat. They're good times to be watching where that market goes up. Here is your 2020 dip. Of course, it comes under, and away we go again. Look at these dips in September and November, October of 2020. Underneath the 30, bull market continues on again. Now, we'll continue to watch as you can see the greed wear off as the market rises towards the end. But we're still in those early stages. It's absolutely fine for the greed to be above those levels because we are coming out of some extreme periods of a bear market. We had a cycle low in 2020. So that's the fear and greed. Everything's looking on track. NASDAQ, same sort of thing. But of course, the percentages are going to be more to the downside because they were a lot more to the upside. They were over 50%. Can you believe that? The people who are waiting on the sidelines expecting a total collapse of the market. Meanwhile, the NASDAQ was getting within a few percent of its all-time high. We're expecting a collapse from that point. So we're looking to the downside, 50%, somewhere around here at the moment, 14.4. If that breaks down, we will move our 50% and just keep looking for the next levels on the macro scale. This would probably be my last line of support here around 13,200, 13,300. But for now, these are like our moving averages. We're just waiting to see how the market responds to these particular levels. Moving on again, this is just giving us a bit of an understanding to the fear porn that's out there. The word recession. So the Russell 3000, you've got the Russell 2000. These are basically the bottom companies out there, the smallest 2,000 or 3,000 companies. When they did their quarterly earnings, the mentioning of the word recession has been dropping. So it doesn't mean they know what they're talking about, but they want to use the words that the public wants to hear at the time in the market. They've used the word recession more so in 2022 at the bottom of the market when there was no recession. But I guess they had to explain to their shareholders that they are preparing for a recession. Now, something interesting that I heard the other day, I can't remember where it was from, but it was another very good trader and investor talking about if these markets were preparing, or if these companies were preparing for recession, and now we don't have a recession, what do you think they're going to do? They now have to flip into overdrive the other way, because if you're preparing for a recession as a company, you're not spending, you're drawing back, you're laying off staff, you're doing all these sort of cost-cutting measures. Now, the market's going up. They need to get their act into gear, and they are so far behind. That's why we're seeing these markets pump through the S&P, through the NASDAQ as well. And eventually, you're going to see it on the Russell. We've seen the Russell start to move. These are going to have bigger moves, ups and downs, especially in the volatile stages, of course. But overall, we are seeing these markets rise because a lot of companies were off guard, preparing for a recession which never came. Now they have to flip into overdrive and pump these markets. This doesn't happen overnight. This is not a daily thing. This is going to be over the course of months and years, of course. The other piece of the puzzle is the REITs positioning, basically the real estate investment trusts. The fund managers are now net underweight their REITs like they were at the bottom of the market in 2008. So they've dropped their REITs, their real estate investment trust positions, the fund managers here, and it's basically at the same levels as it was in 2008. That bottom lasted from around 2009 to 2012, started to get a higher low, but it was basically flat when we're looking at the land, the real estate, the housing prices of that era. And they're doing the same thing again. So I suspect we'll start to see them come into the market over the coming years, just like what happened here, and they will get it wrong at the peaks again. So they were overweight here at the peak. That was the peak of the land market. That was the peak of the stock market. And then they quickly flushed out as the market came down. On to Bitcoin and crypto now. Crypto, fear and greed index at 50. We've been looking at this, waiting for a reset because we're getting lower highs, higher lows. I think we're probably going to go through some sort of flush out eventually here for the crypto fear and greed index. We've been looking at these levels of around that 50 and 40 to give us a reset of the market. Where is this going to happen in price? That's anyone's guess, but we can have some targets in mind, which we'll look at now. So fear and greed, we're looking at a resetting of the market sentiment. It's been hyped up for some time. And in terms of timeframes, we've gone from bottom to top in 35 weeks. So we've been up for 35 weeks. That's a very, very long time. That is longer than the 2021 bottom, or the crash that we had in 2021 to the top. It only went up for 20 weeks in that period. So we've been up for 35 weeks. We need to have some sort of pullback or consolidation period in the market, just like we've seen in shorter term timeframes here with a couple of weeks down. And then we have 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks to the downside. before we pumped up again for a few short weeks there. Now, in terms of what Bitcoin has done twice already in 2023, I take off these particular fibs. We've got the first one here. It has come back and retested 50% and then pounced from that point. The next 50% level, same sort of deal. From the low, this was where the fear porn was at, and then we had a collapse into the 50% level. Again, it's done it twice. Now, like we talked about already on the channel here, we were looking at a potential retest. You guys remember that when we saw the same thing back at the last 50% level, we had an almost retest, just like we had a couple of weeks ago, and then we finally got the retest and it pushed through the 50% level. The same thing we had back here as well, a little push through the 50% level. Note that we didn't have any sort of closing basis under that level. This is the weak part of the 50% tool. This is the stronger part of the 50% tool, looking at this particular range right here. So moving forward, worst case, best case. Best case is we have some sort of hold here. We have a bounce at our 50% because the market has almost touched it, almost to the dollar. The low at the moment, 28,316. The 50% level is 28,306. It's a $10 difference. Almost dead on our 50% level, and that's basically a potential buy zone for a longer term hold. Will it go lower? It has the potential. I can't support the market myself at these levels, but these are good areas to see some sort of support here. Now, the worst case, if we start to break down from these zones and get closing underneath these levels, then that means we're in the weaker zone, and that means we take longer to come back and test the upside. Is that a problem? I don't necessarily think so because of the time that we've taken to go from the, we've got one low here that was 35 weeks, and we have the actual low in terms of the dollar, 33 weeks. Nonetheless, it's basically in that 30-ish week period. So to the downside, maybe we see a 50% in time. We see some sort of 15, 16, 17 week underneath this high, but that doesn't mean we have to collapse for 17 weeks. We can go sideways for 17 weeks. So if we did break under these levels, it's not good for the overall structure, or I guess hitting some of those $160,000 targets in 2023, which I absolutely think is not going to happen, but I am not a bear. But it is just normal for this market to consolidate, just like we've seen in the past. We've seen several weeks of consolidation in the 2019 to 2020 period. We've seen several weeks of consolidation in the 2016, or basically you can go back into 2015 to 2016 period as well. From the low in 2015 to the peak was 42 bars. So we're somewhere around that 33, 35, a couple of months off that period, but it still takes those longer time frames out of the initial low, which lets you know that time is on our side and that we've seen the move up longer than what we've seen in the past. All of the moves to the upside have been relatively subdued over the course of the bear market. We've gone through and counted these before. You know, you've got 4 weeks up. The next move from the January low to the March top is 9 weeks up. The move out of the June low to the top was 9 weeks up again. So we're seeing extended periods to the upside. So don't worry too much about the price. It's the time that we want to get right. The timing, we've got a lot of time on our side to this move to the upside. 33 to 35 weeks from those November lows when FTX collapsed. To the downside, in the bear market, we saw 11 weeks down, top to bottom, right here, 11. Don't worry about the price or the percentage, 11 bars down. Then from March to the June low, we saw another 11 bars down. Then from the top to the November low here, 12 bars. If you want to take the exact dollar low, that was 14. I'm using this bar here because that was the week FTX collapsed. So a lot of the fear porn was out there, but 2 weeks later, we had another low there. So 12 to 14 weeks, very similar on all of these moves down. This time around, we've only seen 2 weeks down. We've seen 9 weeks down. If we extend it out to what we've seen there, let's look at around 11 weeks. It's going to take us out to the end of September. We see 12 is going to take us out to October. We see 14 is going to take us out to mid-October. And like I was talking about before, half of the move up, say that sort of 33 to 35, so 34 weeks up, Half of 34 is 17. 17 takes us out to early November, which puts us well in line with the possibility of the S&P also finally getting its move on towards Q4 before we break out. A lot of numbers to remember, so don't go anywhere. Hit that like and subscribe on the channel. Links in the top of the video description for TIA Premium. Join our members that are crushing the market in these times. They're winning because the market is volatile. We're having small moves here and they're making big gains. As I said, the timing is the most important, but I know many people are waiting on price targets as well. So let's have a look at the price targets for the worst case scenario. Now, this is a key low here in June. That is 24,750. That is the key level that we don't want to see any closes under. That was basically a retest of the double top. So once we see the breakout of the double top, we really do want to see this push on quite quickly. 32,000 is the level to break. But to the downside, the major 50% now from the top to the bottom, we could pretty much say that this is probably the cycle top for this first stage of the move, is around 23,650. So we don't want to see any closes underneath that level. We may see, for the worst case scenario that is, you can see some moves to these levels, some tests, and then just remain in this region between 24.5 to the peak here at 32 over the course of the timing that we've just gone through. This is eventually going to play out because of the volatility. This is the lowest volatility that Bitcoin has seen since 2016. Basically, when the price ranges have been the absolute tiniest and the least amount of movement relative to Bitcoin's price itself. So eventually what we see is some sort of quick moves to extend the range of the bars. Maybe we see that to the downside and a quick push up. Maybe we see it to the upside and we push back into this area, or continue on from that point. Up, down, sideways, you know the deal here. But as long as you're prepared, you're going to understand what to do if you see the move down or if you see the move up. The market is about preparation. It's not about being a hero saying it has to go up or it has to go down. It's about being prepared. Like and subscribe. I'll see you guys back here at the next video. Thanks once again. Till then, peace out.